Hey everyone, welcome back to Stock Market Analyst. What a week it was for the US stock market. We started the week with record-breaking highs, fueled by the unstoppable AI boom and Nvidia mania. But by Friday, investors were dealing with one of the sharpest sell-offs we've seen in weeks. So what exactly happened? Why did markets reverse so quickly? And most importantly, what could move stocks next week? Stay tuned because the inflation report coming next week could determine the direction of the market for the rest of June. Let's dive in. On Monday, June 1st, all three major US indexes, the S&P 500, Nasdaq and Dow Jones, pushed to fresh all-time highs. The biggest driver, Nvidia. After unveiling its next-generation RTX Spark AI superchip at Computex, Nvidia surged more than 6%, reigniting excitement across the entire AI ecosystem. Stocks like Dell and HP followed higher with double-digit gains, as investors continued piling into anything connected to artificial intelligence. The message from Wall Street was clear: AI remains the dominant market theme. But while tech investors were celebrating, another risk was quietly building. Oil prices surged. West Texas Intermediate crude climbed into the low $90 per barrel range after reports suggested Iran could potentially close the Strait of Hormuz amid rising Middle East tensions. Why does this matter? Because higher oil prices can lead to higher inflation, and higher inflation can force the Federal Reserve to keep interest rates elevated for longer. That's where investors started getting nervous. Throughout the week, economic reports showed that the US economy remains surprisingly resilient. Manufacturing PMI came in above expectations. Services PMI also beat forecasts. ADP employment data showed continued job growth. In simple terms, businesses are still expanding, consumers are still spending, the labor market remains healthy. Normally that's good news. But in today's market, strong economic data can actually become bad news because it reduces the urgency for the Federal Reserve to cut interest rates. The biggest economic event of the week arrived on Friday with the non-farm payrolls report. The US economy added 172,000 jobs, significantly above expectations. Wage growth remained stable. Unemployment held at 4.3%. This report confirmed that the labor market remains strong, and that's where the market's concern began. Investors started asking, if the economy is this strong, does the Fed really need to cut rates anytime soon? That question triggered a shift in sentiment. Despite the record highs early in the week, Friday turned into the worst trading session of the week. Investors rotated out of high-growth technology stocks and into more defensive sectors. Here's how the major indexes performed for the week. S&P 500 to minus 2.72%, Nasdaq Composite, minus 4.49%, Dow Jones, minus 0.30%, Russell 2000 to minus 3.38%. Sector performance, energy, plus 2.82%, healthcare, plus 2.32%, information technology, minus 4.97%, consumer discretionary, minus 6.20%. The story couldn't be clearer. Rising oil prices, higher Treasury yields, strong economic data, and growing geopolitical risks all combined to pressure the high-flying AI and technology trade. Wall Street's 9-week winning streak officially came to an end. Now let's look ahead to June 8th through June 12th. There is one event that matters more than everything else. This is the big one. The Consumer Price Index report will likely determine whether markets rally or sell off. Why? Because inflation data directly impacts Federal Reserve policy. If inflation comes in hotter than expected, Treasury yields could jump, Fed rate cuts could get pushed further out, tech and growth stocks could face more pressure. If inflation comes in cooler than expected, bond yields could fall, rate cut expectations could increase, Nasdaq and AI stocks could rally sharply. Wednesday's CPI report is likely the most important market catalyst of the week. After strong jobs data and resilient economic reports, traders are paying close attention to every word from Federal Reserve officials. Markets will be looking for clues about future rate cuts, inflation concerns, economic growth expectations. Any hawkish comments could put additional pressure on stocks. The 10-year Treasury yield moved higher this week. That trend could continue if inflation remains stubborn. Remember, higher yields generally hurt high-growth stocks and benefit banks, insurers, and value-oriented sectors. Keep an eye on the bond market. It often signals where stocks are headed next. Geopolitical tensions remain elevated. Any headlines involving Iran, Strait of Hormuz, OPEC Plus and damp US oil inventories could move crude oil prices significantly. And if oil keeps climbing, inflation concerns could return to center stage. Even though earnings season is winding down, AI remains the market's biggest leadership group. Watch closely for news involving Nvidia, AMD, Micron, Intel, ARM. Any positive AI developments could reignite the rally. Any negative surprise could trigger another sharp Nasdaq pullback. Last week started with record highs and AI-driven optimism. But it ended with rising oil prices, higher bond yields, stronger than expected economic data, and growing uncertainty around future Federal Reserve rate cuts. Heading into next week, all eyes are on inflation. Wednesday's CPI report has the potential to move the entire market. If you're investing or trading the S&P 500, Nasdaq, Dow Jones, AI stocks, energy stocks, ETFs, or options, this is a week you don't want to ignore. Let me know in the comments. Do you think inflation comes in hot or cool next week? Will Nvidia lead another rally, or are we due for a deeper correction? If you found this analysis valuable, don't forget to like the video, subscribe to the channel, and turn on notifications so you never miss an update.